It's Brian Preston, the money guy.
So let's kind of jump in. Let's first talk about the 20s. Bo, unfortunately, nobody at this table is still in their 20s.
That is correct.
So, but here's the good thing. Even though nobody at this table is in their 20s, that age has given us what we like to call wisdom,
right,
from experience.
I appreciate that.
So we can hopefully fast forward and think about or look back, not fast forward, but look back and think about our 20s. Because this is not Benjamin Button, so you can't fast forward to get younger. But you think about this as, how does this work? And I always tell, for 20-year-olds, why remove the rocket fuel from your financial boosters with debt? And that's really, and I don't use the word rocket fuel I don't mean it as a joke. I don't mean it as it's
actually quite literal.
And because here's the thing, I want you to hear me. If anything else, if you have a family member or you yourself are in your 20s, I want you to know this, because this is what changed my life when I heard this when I was like 17, 18 years old, close to 20 years of age. Anybody out there in your 20s can be wealthy. You don't have to come from money. Don't listen to what the news media tells you. I'm going to give you the stats. Anybody under 30 years of age, all you have to do is just let your money work for you and you can be successful. Yep. If you don't believe me, a simple thing that most people want is to be a millionaire.
Yep.
If you're a 20-year-old and you plan on saving into the traditional 65 years of age, you only have to save $95 a month, assuming what the S&P 500 has been making, since the 50s, which is around 10%. If you're a 25-year-old, you only need to be saving about $158 a month. So when I hear that stat, because I've used that a bunch when we talk about 88 times over, here's what I want people to know. I said $1 million, right? That's what it's going to be worth at retirement at 65. That 20-year-old, their entire investment is $51,000. So where does the other $949,000 come from?
It's from the eighth one of the world, compounding interest.
It is compounding interest. You contribute 5, your money is going to work so hard for you, your army of dollar bills, that it's going to contribute the other 95% of the growth for the 20-year-old. For the 25-year-old, they're basically contributing close to $76,000. So you can do the math on that, and you can see very quickly that $920,000 is going to come from your army of dollar bills. So guys, your money, you might not have a lot. I get it. When you're in your 20s, you're like, Brian, I have to have debt because I just need to live.
Yeah.
And I don't have any money to save. I'll do that when I'm in my 40s. I'll do that in my 50s because I'll hopefully have enough income. You've blown it, because this is the opportunity to let your money be 88 times over, meaning every dollar can turn into $88.
Yeah, and I think that's so powerful, and it's such a common misnomer out there. Somebody thinks about, okay, well, if I have a dollar that I put on a credit card, right? And let's say I have 15% interest and I'm paying on that. I'm only paying 15 cents. That dollar only costs me 15 cents. We would say that that's actually really bad math.
Yeah.
That $1 is actually costing your future self $88.
Yeah.
That's a lot more punitive than a 15% interest rate.
So a lot of you are like, this is supposed to be a debt show. Why are you talking about the growth of my money? We want to show you that rocket fuel. Now let's kind of pivot and talk about, where do debt loads need to be and what are the debts that are impacting people in their 20s. The first one, the largest portion of your debt is going to be student loan debt.
No, it's not a huge surprise that 20-year-olds or people in their 20s, that's the biggest one that they face.
28% of debt load for 18 to 24-year-olds is student loan debt. The average for a millennial household is around $14,800. Truthfully, when I saw that number, it didn't freak me out.
Well, because you think about most universities probably cost more than 15 grand a year, around 15 grand a year. So it doesn't seem crazy that, 1 year of university costs in debt.
Now, you millennials are getting older, so that stat might also have some 30-something-year-olds that are getting close to being out of debt. No offense to you millennials. You're like, I'm a Gen Xer, so I know what it feels like to be the not newest kid in town anymore on getting older. But I do think it's interesting because a lot of people, I can imagine students, in that 18 to 23 age range, it's so easy to go get student loan debt, and you have nobody, no uncle or parent that's giving you guidance on this stuff. You're like, well, how much student loan debt is okay? Because I know that it's okay to use debt for good things like houses, which are hopefully appreciating, and for student loans because I'm investing in myself, and this is going to allow me to make more money. But how much debt is okay? And this goes into so many decisions when you're choosing your college. Should you go public school? Should you go private school? What major should you take? Here's the guidance that's going to keep you out of trouble. You should not let your student loan debt exceed what you think that first year anticipated income is going to be.
So if you go out there and you think that right out of college, your first year of employment's going to pay $40,000 a year, you probably shouldn't have $140,000 of student loan debt. That's a mismatch. You want to make sure that you keep it below that first year's annual salary.
And I would also, if you're going to choose a career path that's going to pay $40,000 or $50,000, pay attention to where you go to school too, because some of these, I'm always amazed when we do college planning analysis and people show me these private schools that they're going to go to for college. And I say, well, what's the earning potential of the career that you're seeking? I'm like, I don't know if that
justifies the cost.
So pay attention, because it's those type of decisions that go into running that debt up. So pay attention to that.
And so what I'm hearing you say is before you even decide to take on student debt or before you encourage your kids to take on student debt, you kind of have to begin with the end in mind.
For sure. It requires some vision planning to know what you expect out of your college experience, and then also how to structure that financially if you're going to use something like student loan debt.
Love it.
And then, Bo, you brought up, and I'll let you kind of close it out before we move on to the next thing, was you said not all debt is created equal. What did you mean?
Yeah, one thing you need to be aware of is when you go out there and get student loan debt, I mean, obviously there are different kinds of loans. There are subsidized loans, non-subsidized loans, parent loans, student loans. But what I'm actually talking about is some types of debt, and I'll use my wife as a specific example. When she graduated, she had some student loan debt, and she was a school teacher. She wanted to go be a middle school teacher. Well, her program, one of the loans that her university offered said, hey, if you go teach either math or science, we'll forgive up to X amount of that student loan debt. So there's actually a mechanism where some loans are forgivable depending on the vocation you choose.
The public service debt forgiveness type program.
So that's another example, public service debt forgiveness. There's all kinds of amazing Google research you can go do on that, where if you work in a certain sector for a certain type of entity, you could even potentially have some of your student loan debt disqualified.
I know there's been a lot of stuff in the media about a lot of people didn't qualify for that public sector service for debt forgiveness. I would go, was it White Coat Investor does a lot of research. And so if you're one, because there's some of you doctors out there that have done your resident work at a public university hospital, you might have some opportunities. So go check into that. We'll move on because that's a whole nother topic, but we like to throw those little tidbits out there for you. Let's talk about credit cards.
The student loans we were kind on. I feel like we can be less kind on this one.
No, for sure. This is where, and by the end of this, y'all are going to be like, because, I allude to him, but Dave Ramsey is spot on if you, on credit card debt, if you are not a disciplined individual. And unfortunately, the lion's share of Americans are not disciplined with their credit card debt. So when people ask me my opinion, like on Dave's advice on not using credit cards at all, I got to tell you, the results of behavior of the average American shows he's probably closer to right than those of us who talk about discipline use, because the average person just has no willpower.
Sense of discipline,
and I want to talk about that because I know when I was in my 20s, I was always scared of debt because my parents had me thinking that you signed up for debt and then back hair was going to start growing or something bad was going to happen to you. It was one of those things that really, it was irrational. And I remember being in college at UGA, at University of Georgia, and I kid you not, I think that, I think they have changed the rules specifically because of these behaviors. I would see a line of kids signing up for credit cards for a bag of 79-cent Lay's potato chips.
Oh, yeah, or a free T-shirt.
Or a free T-shirt. Yep. And I even remember then having zero to my name, not even having a credit card or understanding that's a failure. That's probably not. And I knew so many friends that ran up $2,000 to $3,000 of credit card debt off of lifestyle. Sure. And then they'd have to go work some bad job, beg a relative, or do something to get out of debt. That was just the story that you went on. The thing I would tell you is that among millennial people that are 25 to 34 years of age, credit card balances are their leading source of debt.
And I think even the number is, 25% of their total debt load are on credit card balances. And by the way, I don't know if you recognize this, credit cards don't often have the most advantageous terms where you're paying like 3, 4, 5% interest if you're carrying a balance. It's usually something a little more aggressive than that.
I don't think you should ever have what is called credit card debt. Debt implies to me that you have a balance.
Yep.
You can have credit card use, but you should never have credit card debt.
I think that is well said. And I think it's a little bit different than some other popular opinion out there.
I mean, if you are not paying your credit card statement off monthly, you're doing it wrong. I'm just going to go ahead and tell you, it's one of those things we've talked about that you're all hat, no cattle.
Yeah,
I've
exactly
used
right.
that in previous shows. And then also, I don't like people who fake lifestyle and consumption just because they know that good things are coming, so they go ahead and try to accelerate those things for their benefit way ahead of schedule.
That's right. One of the things, obviously we record this show live, so if you're out there listening to this not live, we have a live chat going on, and someone actually said this in the live chat, and Brian, we had it in the notes. Anytime you go and secure debt, all you're really doing is borrowing from your future self. You are accelerating consumption from the future into today, and this is what's so sad about
Taking that rocket fuel.
You're borrowing from your wealthier future self and making that person less wealthy.
Yeah. You hear about economic outpatient care. That's where you have adult children who come back to really pull off of your finances. You're doing the same thing with your army of dollar bills when you use credit card debt at a young age. And the thing I always think about is that we just did a show on funny words that impact your finances. And one of them was the Hedonic Treadmill.
That's right.
And this is what we learned about thinking about that is that the way the human brain processes fulfillment and happiness with money is that you should slowly increase your lifestyle so that you enjoy all steps of the ride. Right. Because the research shows that if you go from a 15-year-old, let's just say I had a raggedy Cavalier Chevy car, you know, that was like, it really was like 15, 16 years old. If I would have gone from that car when I graduated college to, let's just say, like a Mercedes, a Cadillac, some premium brand, I would have felt great. It would have been one of those moments where happiness would have been awesome about getting it. But the research shows Brian going from that car to a Mazda probably wouldn't have been any different.
Yeah.
I skipped a bunch of steps along the treadmill, but my happiness factor would have settled in because here's the thing, guys. Coming from a guy who reached a level in my career, the human condition has an incredible ability to absorb and consider it normal whatever you're doing in life.
Right.
You have a beautiful big house, 6 months into it, it'll just seem like your house.
Just seem a house, yep.
I mean, so be careful of that. The way to really create fulfillment is to move up that lifestyle very slowly, and then you'll truthfully you'll have more money to save and invest in yourself, which is going to be helpful. So
you said it perfectly, Brian. You said this to start with. Our advice on how you should handle credit card debt in your 20s, and I don't want to do too much of a spoiler alert, this is the same for 30s, 40s, 50s, and so on, is you should pay them off every month. You should not carry a balance on credit cards. It's just really not super justifiable to do that.
Credit card debt should not exist in your life. Like I said, credit card use is okay because that's assuming that you're paying it off every month. If you find out that you can't do it, you know, and you're 25 years old and you're not paying that credit card, you really might need to go check into some of Dave Ramsey's books. You know, and his lifestyle is you just don't use credit cards.
That's right.
I'm at least giving you the option if you're responsible, because I think there's people that can do it. But based upon the research, it's a smaller number than unfortunately we'd all like to admit.
So one of the things we want to do, and one of the things that you guys have told us that you like when we do these By the Decade shows is, all right, give us a litmus test. How do we know? Where's the average? Where should we be? Well, where should you be is you should be at zero debt, right? I mean, that's kind of the dream that we all live for. But
That doesn't
realistically, in your 20s, we thought it'd be helpful to share what the average debt load of someone in their 20s
This doesn't
is.
mean where you are. We want you to be less than this, but this is the average.
So what we found is that the average debt load for someone from age 18 to 24 is $22,000. Now, one of the things that's interesting about the numbers is
This is personal debt. Remember, does not include mortgages.
That's exactly right. We purposefully excluded mortgages because we recognize if you're listening to this in
San Francisco
Bay Area, the cost of living, cost of home ownership, cost of residence is very different than if you're listening to it in Sheboygan, Wisconsin. Is Sheboygan in Wisconsin?
I mean, I was just going to say, like somewhere, like I have relatives in, North Carolina, South Carolina,
Yep.
and places like that. And, so if we told you the average mortgage was like $135,000 and you're out in San Francisco, you'd be like, get out of here.
That's right.
I mean, so it's not even worth including that data.
So what we're talking about is non-mortgage personal debt. So credit cards, student loans, auto loans. So the average from age 18 to 24, so this is the early 20s, is $22,000. Average from age 25 to 34 is $42,000.
That's a good point.